Growth is slowing down for this high-flying growth stock. The trade desk is down 26% after hours after reporting their 2024 earnings results. So let's find out what these results had in store and why the stock is down so much, and most importantly, whether the stock is a buy today or not. So the trade desk is an advertising technology company, and essentially it helps connect people who have ads that they want to show to people. It connects those people with platforms that can show their ads. So I put together this nice little PowerPoint slide to illustrate exactly what it is the trade desk does, because it can be a bit complicated. So the trade desk has, in my opinion, 4 main value propositions for companies. So the first is targeted advertising. Let's say you have a company like Nike that sells athletic wear and they want to put together an ad campaign, but they only want to put together this ad campaign for athletes. The trade desk collects lots of data on different types of consumers, and they can help Nike target specific people such as athletes. That's targeted advertising. Another interesting aspect is bidding, and this is real-time bidding. So let's say Netflix, that's what's called a sell-side platform. They have content and they're looking for ads to put on their content, right? Netflix just announced that new ad-supported tier that lots of people signed up for. That's why their earnings were so good this past quarter. So Netflix has their advertising tier, but they need ads to show on it. So Netflix says, all right, everybody bid on what you think you should pay in order to be on our platform, shown to tons and tons of people, and whoever bids the highest is going to get that spot on our platform. So that works out for Netflix because they're making all of these businesses fight against each other to get a spot on Netflix. So Netflix is going to get the most money and the highest paying bidders. This also works well for the bidders because if you have deep pockets, you can shell out a lot of money and you know you're going to be shown on Netflix. So that's bidding. Cross-channel advertising is the third thing that Trade Desk does. And this is essentially an advertiser can put together one ad campaign and show it on multiple types of devices. So if you want your ad to be shown on people's smartphones, on smart TVs, on Netflix, on YouTube, you can run the same ad that'll be shown on all these different platforms through one company, the Trade Desk. And finally, they have data analytics, of course, because every company now has data analytics and custom segmenting. So let's say you have a very niche product. Let's say you sell vegetarian hypoallergenic cat toys to vegetarians who have hypoallergenic cats. Well, Trade Desk has so much data that they say, we think these people are vegetarians and we think they have hypoallergenic cats. So your ad is going to be shown to these very, very hyper-specific people. You can do that all with the Trade Desk. So as you can see, advertising and technology come together. That's why I call it an advertising technology company. So let's get back to the earnings results because that's the big news. The stock is down, like I said, 26%. Now, I think we need to take this with a grain of salt because if you zoom out over the past year, the Trade Desk is up 65%, and in the past 5 years, it has quadrupled. So it's not like this was a cheap stock. This stock has been performing quite well. In fact, if we look at Morningstar's valuation of the Trade Desk, now Morningstar is a financial subscription service. They have a team of analysts who give stocks a score, 1 star being significantly overvalued, 5 stars being significantly undervalued, and you can kind of get an analyst's opinion on a company. So they think before the drop that the Trade Desk was significantly overvalued at a 1-star valuation. They think the fair value for Trade Desk is $60 a share, and they said it was trading at a 100% premium. So even after today's drop, the share price is around $90 a share. So that would still be about a 50% premium, but that premium has been sliced in half, according to Morningstar. So that is likely the main reason for the big drop. When you're a company that's priced to perfection, you're going to be punished more severely from missing earnings than a lower, less expensively valued company. Trade Desk missed analyst estimates for the quarter. They reported $740 million in this past quarter versus analyst estimates of $760 million. So that's a pretty decent sized miss. However, what also came up short was the company's guidance. For the following quarter, they're looking at revenue of, they say, at least $575 million. So that implies 17% year-over-year revenue growth. That's a bit of a slowdown. When we look at their revenue growth annually, we can see that it's always been over 20%. This past year, it was 26%. So all of a sudden, the quarterly year-over-year revenue growth is slowing to less than 20%. I think that has a few people spooked, and that's why the stock is selling off. They missed Wall Street's estimates for revenue for the quarter, and their guidance for the following quarter is nothing terribly exciting. However, we need to keep something in mind. Notice how in fiscal year 2016, the company grew revenues 78%. And then a couple years later, 55%. And then a couple years later, 43%. You can't have 20% revenue growth forever. It's just not possible. At a certain point, your market is going to be exhausted and it's going to be very difficult to continue to grow revenues. So it's natural for revenue growth as a percent to slow over time. What needs to happen then is that the company needs to rein in their spending and become a bit more profitable. Once they've captured all that market share, they need to monetize it. The Trade Desk is a monetization company, so they should know all about that. And that's exactly what they're doing. In this article from MSN, they say the Trade Desk's revenue fell short of expectations. It did, but their net income grew 88%. So they're doing exactly what I said. They are focusing on growing now their profits first and growing their revenue second, in my opinion. At a certain point, it's going to be very hard to continue to capture market share. And even though the Trade Desk does have a lot going for it in their technology-driven advertising platform, they already rake in so much revenue that it's getting more and more difficult to grow that revenue. They made over $2 billion in revenue last year, so this is no small company. Another bright side of the earnings report is that they did increase their share buyback program or share repurchase program, and they are now authorized to buy back up to $1 billion of shares. Now, the Trade Desk before the drop was a $60 billion company, and after the drop, it's looking like a $45 billion company. So this represents maybe about 2% of the company's market cap. Okay, so Trade Desk helps connect advertisers with these platforms that need advertisements. They say we buy the whole internet. They have a very large market, but their growth is starting to slow. Is the stock a buy today? Well, let's find out. This is my disruptive growth stock spreadsheet where I rate growth stocks on 4 factors. Those factors are gross margins, annualized revenue, price to annualized sales, and year-over-year quarterly revenue growth. I use these 4 factors because they take into account top line, that's sales, not profits. Profits would be bottom line, to see how well a company is capturing market share and how much you're paying for that growth. So price to annualized sales is, of course, valuation. Annualized revenue shows how much market share the company has captured. I reward companies that have larger annualized sales, and I punish companies that have smaller annualized sales because it's much easier to grow when you're smaller and it's much harder to grow when you're larger. So Trade Desk, being a mostly software-oriented platform, has very high gross margins of 81%. They're also seeing 26% quarterly year-over-year revenue growth. Now, if we look at their guidance, that drops to 17.1, which does lower their score quite a bit. But I'm just going to go based on what they just reported for the previous year. So in my growth stock spreadsheet, I rate companies on these 4 factors and I give them a score. You can get a possible 5 points from each category for a total possible of 20. The highest on my list right now is about just under 17, and my average is about 11.5, and Trade Desk is just under 11.5. So Trade Desk looks at an average valuation for the growth stocks that I look at. And this is after the implied drop with a market cap of about 45 billion. So what we see is that their price to annualized sales, which used to be in the 20s, is now at 18 times. So 18 times annualized sales is still quite expensive, but we have to keep in mind that this is a fast growing company with strong gross margins and they are profitable. So for those things, you do have to pay a premium. If their gross margins were 20%, I certainly wouldn't be paying 18 times sales, right? If you're somebody who's interested in the Trade Desk and you've been on the sidelines, this might be a great entry point. And in fact, I may consider starting a position in the Trade Desk myself. One more thing to look at when considering if this stock is a buy. If you know me, you know I love a good balance sheet. I love the balance sheet. It shows the financial health of the company, and a good balance sheet is often the sign of a financially prudent company. So, Trade Desk balance sheet, what I'm looking for here is, first of all, very surface level, do their assets outweigh their liabilities? We have total assets, 6 billion. Nice. Total liabilities, 3 billion. Okay, twice as many assets as liabilities. I like that so far. Now let's look at their current ratio. That's going to be current assets. These are things that can be turned into cash within a year. Current assets make up the bulk of their assets at $5 billion. $5 billion can be turned into cash within the year. Amazing. Current liabilities, things that come due within the year, 3 billion. Okay, so the current ratio looks good. They have 5 billion in current assets, 3 billion in current liabilities. That leaves them $2 billion left over. So a lot of times what you want to look for that might be artificially inflating a balance sheet is what's called intangible assets. So these are things like goodwill, licenses, patents, things that aren't really tangible. It's more of just a arbitrary value that's been ascribed to these quote unquote assets. And sure, they're assets because they do have value and you can sell them. Well, maybe not goodwill, but they're not a true asset. So when I'm looking at the Trade Desk's balance sheet, I don't see any of those things. I don't see any intangible assets. All of these are actual assets, cash. Short-term investments, accounts receivable, that means people are going to pay them soon. Property and equipment, I don't see anywhere, patents, licenses, or goodwill. So these are true assets. I'm loving the balance sheet for the trade desk. That shows me that this company is in good financial health, and I can sleep well at night if I do choose to buy shares of this company. So, final thoughts. The trade desk, for me, this dip does look appealing. It's a company that I used to own and I sold because I thought the valuation was getting a bit high. And now the valuation, it's not low, but it's definitely more reasonable. And I think a lot of times what happens with these highly valued growth stocks is that they get a bit of what's known as a re-rating. So they had this very, very extreme valuation because everyone was super excited about the company. And then people start to realize that maybe they got ahead of themselves and the company comes back down to earth. And I think that's what we're seeing here. The stock is coming back down to earth. And I think this makes a great entry point for somebody on the sidelines. But just remember to always do your own research. This is not financial advice. These are only my opinions. And if you are thinking about buying the trade desk, make sure you do it on your own convictions. And perhaps consider using a dollar cost average approach. That's what I like to do when I enter a new position. So that simply means that, let's say you want the trade desk to be 5% of your portfolio. Start with a position of 1% of your portfolio. If it drops more, add another percent. If it drops more, add another percent. And even if it doesn't drop, add another percent. You see what I'm getting at? So this sort of eliminates market timing risk and allows you to accumulate a position that gets some of the lows and maybe some of the highs. Thank you guys so much for watching the whole video. If you liked it, please hit the like button and please let me know your thoughts on the trade desk in the comments below. If you are new, please subscribe. I make stock deep dives and earnings analysis videos of stocks. So if that's your cup of tea, definitely subscribe so you can see more of that and you can hear my lovely voice about once a week. Thank you guys so much for watching and have an amazing day.